Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted today to be able to speak to accomplished fund manager Rosemary Banyard of Downing. So welcome, Rosemary.
Hi, Paul.
Well, we've got lots of key macro data coming out over the next few weeks, not least Friday's US payrolls report, but also a host of UK companies are still to report their full year results and their outlook. So putting all that together, what's your sort of outlook for equities going forward, particularly in your sort of sweet spot of mid and small caps?
Yeah, so I always find this question difficult because I don't base my investment decisions on the macro. The first thing, I don't actually think I can forecast it. So I'm very much what the trade is known as bottom up, picking individual companies and for their merits, and almost trying to find businesses that will do well regardless of the external environment. I mean, that's not always possible, as we know, but that's the sort of aim that there's secular growth or reasons why a particular business might grow. So I'm not sure I'm the right person to ask
Okay.
that question of, actually.
The problem, I suppose, is we're not, because I mean, I'm a stock picker as well. In terms of, companies don't work. They're not in isolation. They're not in a goldfish pond, and they have so many different influences they can, affect in self help and stuff, and that's great. But when it comes to sort of laying over that macro side, obviously, if the tide's coming in or the tide's going out, it's a bit of a headwind for a couple of years,
Yeah.
as we've seen in small cap land. I mean, I suppose a more broader question: when's this tide going to turn against small and mid caps in the UK?
Yeah, and I wish I knew. I mean, I take your point, and I think the big sea change was the expectation that interest rates were going to go up, and that inflation was out of the bottle, which goes back sort of probably 3 years now. Actually, feels a long time, and so one of the biggest influences on sentiment in this area does appear to be the direction of interest rates. And I think it is widely expected that UK, inflation is going to sort of, for annualizing reasons, going to be low in the next month or two. And the state seems to be a bit ahead of us in the interest rate cycle, maybe, but I think there's so many other factors at play at the moment. It's been much talked about, of course, recently that there's been this huge sort of exit from UK over many years, actually, to sort of global markets, and also into bonds. If your pension fund, there's been a big switch out of equities into bonds. So there's been all these sort of headwinds. And when's it going to end? So, well, I think things are a bit better than they were. So my sense is that the sort of absolute flood of selling isn't quite there to the same degree. I mean, it was the case that companies would come out with really good results, then shares would go up, and then they would drift down and down and down, and actually end up where they were or even worse, almost regardless of what they had said. And you started to wonder, but I think it was just the weight of redemptions and therefore funds having to sell out of holdings. Some of them were illiquid, and just sort of an absence of buyers. And my sense is, although there's a bit of that still going on, I think I don't think it's as bad as it was. And you've got various counterbalancing factors now. So you've got I don't have data on it, but there seems to be loads and loads of buybacks at the moment by
Yes.
companies in the UK. I mean, more and more being announced. There's also the well documented factor of more takeover bids. So on that one, it was running at about 40 to 50 a year takeover bids in the UK market from about 2014. But last year, I think it was more like 60. And obviously we've gone off to a massive start this year again. And so you've got takeover bids putting money in. You've got companies buying back their shares. You've got a bit of an easing of redemptions, if not completely stopped. You've got the possibility of, this review of potentially having a British ISA. You've still got people. I mean, I was on the paper at the weekend, wasn't it? So one of the brokers calling for CGT relief for entrepreneurs if they, were to list their company in London, and trying to just get more quality companies to list in London. Which, if there were more decent companies, I think that might help. So there's a whole raft of things that are supportive.
Yeah. Well, I'm hoping there's going to be a few raft of companies coming from your neck of the woods in Cambridge, because it is a bit of a hotbed of really good ideas like ARM and the biotech sector. One thing that hasn't really changed much, even though the market sentiment has improved, is liquidity. It still seems in the small cap area terrible, and as evidenced by an increasing number of companies delisting. And what's causing that? Is it basically just fund manager redemptions, or alternatively is it just people deciding, actually I don't want to go anything less than 100 million market cap, and therefore just because I won't be able to get in and out?
Well, I think as with everything, it's a bit of both. But I do think that there are various factors. So I think regulatory pressure or scrutiny does make it harder for people to invest in a whole raft of illiquid stocks. I mean, we're all being asked to monitor liquidity in our funds on a very regular basis. We get asked about it, and I think some of that is probably the aftermath of the Woodford debacle. The effects of that. So that's one thing. Delistings seem to be happening, for my money, more at the really small end, which I'm not involved in. I would say, and of course there you've got the whole thing that the costs of being a public company are quite high. We've seen the size of that annual report go from something manageable to a complete sort of novel.
It's War and Peace, isn't it?
It is. It is. So it is difficult, and it's very hard to push back on unnecessary, regulation and unnecessary disclosure requirements. It never goes the other way, does it?
I guess that comes at the smaller end. I guess it shows you there's a greater importance for retail investors actually to get that liquidity of the sort of self-managed funds and stuff like that. But hey, we eventually it'll turn with a bit of luck. Okay, well let's move on.
It will.
Yeah, let's move on to some stocks, and one you've done really, really well, which has done sort of like been a real workhorse, has been Tristel, which does sterilization. Sort of fluids, cleaners and foams and stuff for hospitals, small sort of instruments, ophthalmology and ultrasound, but also surface cleaners. Can you take us through this one, because it's done brilliantly, and also an update on how you see the US transition, because it seems to have now got a beachhead there.
Yeah. So Tristel was founded, I think, something like 25 years ago by Paul Swinney, who is still currently the chief executive, though he has announced he's going to retire. And it started just selling to the NHS. And over time, it has developed its business so that now I think it's something like 2/3 of revenues are from outside the UK. So it's following the trajectory of an ideal small business that maybe starts in the UK and then internationalizes, and goes for the world basically. So he's been quite clever in putting something I'm quite keen on, barriers to entry around the business to keep out sort of competitors, and these are patents. But more importantly, perhaps getting equipment manufacturers of the ultrasound equipment or the ear, nose, and throat, or the ophthalmic instruments to say that if a hospital doesn't use chlorine dioxide, which is the method that Tristel have, to disinfect its instruments, then their warranty might be invalidated. So that's quite an interesting one. Why would a hospital take the risk of using bleach or some other substance and invalidate a warranty? It's just not worth it. And they've also had the helpful driver that their chief competitor uses a different method, which involves carting the instrument off and putting it into a cabinet and disinfecting it, and then bringing it back, which is not ideal for outpatients. You want to have a quick turnaround. You don't want to have twice as many instruments as you need. So it's an interesting setup as a business, and they keep going and getting permissions. But the big one, as you say, was that they got permission from the FDA in the United States last June, initially on ultrasound, and they have very cleverly selected as their distribution partner a company called Parker, which is a family business similar size to them, which invented the conductive gel, which if you have an ultrasound, they put the machine over your tummy, say, and but it rides on this gel. So Parker are going to distribute the disinfectant as well. It's the ideal partner for that market. And they are now looking then to get other permissions from the FDA for other applications. And whereas the first one was really hard, it was what's called a de novo permission. They had to start from scratch. There's no chlorine dioxide methodology in the States. Now that it's accepted as a new method, all the other applications will be much quicker. So there've been some brokers saying, well, it's going to be a slow burn, a slow take up, and that may be true. But if you're prepared to take the longer view, it's the healthcare market in the States is huge.
Yeah, I think it's only like $4 trillion, isn't it? Size
and
the UK economy.
And they have a royalty model, so it'll be very profitable for them.
Yeah, just more broadly, where you have such a sort of winning partnership between Paul Swinney and Liz Dixon, I think is the CFO, and they've worked together very closely and nurtured this business over the last 20 years. When you get one of them obviously retiring, and I don't know how long Liz wants to obviously carry on, how do you view that? Because they've really not sort of like put a foot wrong for 2 decades, and now you're going to have a new management team coming in at some point.
Yeah, so that is a concern. They are looking currently for a new CEO. They've got internal as well as external candidates, and I think that Liz is one of the candidates actually. And so that will be interesting. And maybe there's more than one internal candidate. So we'll see what happens. But Paul, for sure, has been the driving force, the mastermind behind the whole thing. So it's an incredibly hard act to follow. But the barriers are the barriers. Their position in the market is solid. It's there. So it's I don't want to say this, but it's for someone else to mess up. It's not. I think the hard yards have been done.
I wouldn't be surprised, actually, given what the M&A trend, that one of the US competitors who doesn't want Tristel accessing their market comes in and puts a bid on them. But hey, that would be pure speculation. Right, let's move on to another one in the healthcare area. But this one's gone through some trials and tribulations. It's EKF Diagnostics, which does sort of like blood testing is their core business, and has built out another sort of like business in enzymes out in the States, which has gone through a few ups and downs. It's got the previous CEO, now the exec chairman, Julian Benz. Can you give us your latest view on this one? Because it seems to be waiting as a sort of like a cool spring, but we've been waiting quite some time.
Yes, so it's very frustrating, EKF. I mean, historically, I've known Julian for years, and in a former company, BBI, which got bid for many years ago, and at EKF, he did make some of the early acquisitions, which are the bedrock of the business. I think what's really wrecked them, it weirdly, was COVID, because they started making COVID test kits as a sideline. Obviously, it had huge orders and made a fortune, and then went and squandered it on some ill-advised acquisition and entry into a completely new market for fermentation. And really, the history of the last sort of 4 or 5 years has been the boom and the bust of that, where and also possibly took their eye off the core business. But the core business is doing fine, and it's making test kits for some areas which are sadly growing in our world, which is diabetes and also anemia and malnutrition, testing for anemia. And I think so. It's clear to see that there's growth. There's particularly growth in third world, and they're selling into that. And as you say, Julian's come back in, and the core business now does seem to be on a better path. They've taken a hatchet to excess costs that built up. They've got their ebbs and flows in, but they've withdrawn a few old instruments and that they sell alongside the test kits, and that seems sort of a well underpinned. I think that the jury's still out on the fermentation side, where they've got this facility in America, and there is demand, and there's a shortage of fermentation capacity. But it's a question of filling it and filling it at the right margins. And then they're starting to talk about, well, they might expand it, which I think we need to see what kind of returns they actually make on the first plant before make a judgment on that one.
There seems to be a Christopher Mills put on this business. If it goes down, so somebody's going to buy it from Harwood, I think. I don't know.
Maybe.
Okay, right. Let's move on to another sector. Industrials and We've got Elementis here, which is a chemicals business that essentially has gone through a bit of a turnaround, had a bit of debt, and has started to sort of like reduce that. What's your sort of latest on this one? Because is this a secular grower, or is this a cyclical business?
Good question. It's both.
Okay, sorry. Okay, good.
It's both. So the secular growth area is that they have a very valuable asset, which is a mine in California, which mines a substance called hectorite, and it's one of the only and certainly the largest commercial deposit in the world. And hectorite and there's another product called bentonite are used to help products flow better. And here I want you to think about color cosmetics, nail varnish, or
a common
eyeshadow.
one for me.
I know, or possibly paint.
Okay.
Which is perhaps rather than face paint. And so it's a very they've got a sort of vertically integrated supply chain. So they're using their hectorite, most of it they use themselves, and then they make ingredients that go into paint and cosmetics. And it's a real competitive advantage and a very valuable mine with I don't know, at least 70 years of known reserves, and probably loads more beyond that. So they're starting to also develop products for skincare, and I can tell you that skincare products are quite expensive.
Okay.
So the major players, the major brands do very well out of that area, and they've got some some interesting angles in there. So I think that is secular growth. The more cyclical areas are just the ingredients that go into the paints industry, and also they've got some more recent acquisition in talc, which is mines, and this goes into plastics for lighter weight, and is used, for example, in the automotive industry. And it's had a European focus, and the European automotive industry has, as we know, been really under the cosh. Production has been very depressed, and so there's cyclical opportunities for sort of a bounce in those areas which have been depressed, and ongoing growth. But they've also had a lot of debt, which they've largely got under control now. They've just announced the first back to the dividend payouts, which is a good sign. And they had 2 bid approaches, and they've also got an activist shareholder that's agitating for them to be sold. So I feel it's an asymmetric bet. There's not much downside, and actually it's probably still pretty undervalued.
Yeah, there does seem to be an unbundling opportunity, and for a chemicals business to make 15% plus EBIT margins, it's obviously got something unique there, because most of them are on about 5 or 6.
Yes, and the target's higher. The target is higher than that.
Yeah.
Yeah.
Okay, good. Well, let's move to another one with a high quality business. It's Intertek, which basically does testing for all kinds of products, sort of moved around the world, etc. Obviously there's increasing regulation, but how does the supply chain changes, build into this model in terms of reshoring and nearshoring and all that kind of stuff?
Yeah, well, I think it really helps them. It's a real boost because if a company that's, say, been very reliant on sourcing from China decides that it now wants to diversify its supply chain and make it more resilient, and so it starts to think about maybe sort of getting supplies from a different continent, countries, they need to use somebody like Intertek to go and check out the proposed new supply chain at the same time as they still need to keep on testing and checking out the existing one. Right. So this whole business of diversifying away from China is really good news for them.
Yeah. So basically moving from a sole source type of reliance to a multi-source could be a real secular grower for them, because this isn't going to last. This isn't going to take 12 months. This is going to be years, isn't it?
It's a long-term trend.
Yeah. And I do remember a long time ago, wasn't this company bid for as well? 15 years ago? I think it was.
I don't remember that.
Yeah, I think it was. Yeah, no, I think it was. It's one of our real beauty businesses, isn't it, in the UK?
It is. It's there's 2 others in Europe, and the 3 of them are the world leaders. Yeah.
Yeah. Another one in that world leader camp is Rotork, which basically does they call themselves an intelligent flow control business. I think they make sort of like valves and controls and all this sort of stuff into the mining, oil and gas, and also sort of like, I guess, into sort of water infrastructure and stuff like that, fluids and stuff. Can you take us through this one? Because I was just looking at them. They've got a rock solid balance sheet, plenty of cash, around about 130 million. Plus they make, for an industrials business, 23% EBIT margins.
Yeah, and their target is higher as well, and it's in print public target.
They're selling software or something?
No, well, yeah, but possibly a bit, but they it's mainly because it's capital light assembly business. So they design, as you say, a valve actuator. So it's not actually the valve; it's the thing that turns the valve on and off. Right. So it's very specialist. Yeah. And also they sort of put that sometimes together with gears. So they've always been a high margin, high return on capital business, because they have assembly. They buy in the components, assemble, test, and these days they also offer service. So maintenance, if people want maintenance contract. I think it's always been very profitable, but for my money, it was a bit uninspired for a while, and I really like the newish chief exec, who's got an unpronounceable name, because you read it and I think it's Vietnamese, and it when you say it doesn't look anything like how it's written.
Yeah, but I think human or Hyman or something like that. Yeah,
he's called Gig.
Gig.
That I know. He's called Gig.
Wow.
Spelt Kiet, I think.
Yeah, exactly.
yeah, so that's a challenge.
Okay, well, if I ever
Um,
speak to him, I'll remember what he says then.
yeah. So, but he's interesting. He came from, I think, came from IMI, and he's the chair at Rotork was from IMI. So I think he knew who he was recruiting in, and it just seems rather refreshing. He's refocused the business, on margin targets and more particularly growth areas. So I think in the past they've just been rather more cyclical because they'd been focusing mainly on oil and gas, mainly on oil, and of course there's a cycle of capital spending and in that industry, but they've highlighted on some quite good areas of growth. So more to do with, say, LNG. Obviously, they're in the water sector. They're sort of getting involved in carbon capture and hydrogen, and it's just rather more focused on developing the growth areas. So I think that the big thing there is you've got a very highly profitable business, but I think the growth rates hopefully going to tick up and stay up.
Yeah. One feature of the portfolio does seem to be you migrating to the best in class sort of industry sort of champions, really, particularly in the sort of the UK and abroad. And
Yeah.
is that something you look for? And how do you overlay that with valuation? Because
Yeah.
to generate alpha.
Yeah. So I'm very keen on companies which earn good returns on capital, and I'm very much a believer in the fact that if you are patient, a patient investor, and you just let those businesses run, the compounding effect is quite powerful. I mean, I'm not the only person to obviously preach this particular mantra.
Warren Buffett.
Well, yes, and others.
Yeah.
Yeah. And so that's why you're looking at things and thinking, well, there might be a market leader, because in order for them to earn good returns, they've got to have things that keep the competition out. And so I think on the valuation point, that I use discounted cash flow, because I think that one of the things about this is that if you look for, I know a lot of people look at PEs, but typically you're only looking a year or two ahead. And the thing that works best with high return businesses is to look much longer term and just let them get on with it. And so looking at a PE, it might look high for the first year or two, but if they keep going, it comes down. But that's beyond people's forecast horizons. So you're not picking up the compounding effect. And so that's how I look at it. And I try and forecast out a growth rate and a free cash flow, and then discount it back. And I don't assume companies will do anything with the cash that they're going to generate. And I use quite a conservative discount rate. So
in terms of that sort of strategy, because obviously, I look at a number of different companies and stuff like that. If you sort of like go towards the best in class ones, they tend to be, and this is, if they're liquid, tend to be priced pretty highly because people like them, obviously. And therefore, the question is such as do they generate alpha over and above the market? Or actually, you have to actually buy things with a few more hairs on it, so to speak?
Well, I understand the point. I think there is a judgment call about when you invest. So if you
Yes.
think even about the last few years, so my fund started right at the bottom just after COVID hit in March 2020. So that was a good time to be putting money in. But if you had waited until the small and mid caps had surged for 18 months and then piled into certain companies in say late 21, that might you might take a lot longer to get your money back.
Yes.
Because of what happened since. So there are timing factors which probably apply here, that sometimes are better than others, but I'm not a market timer. So I think it's around being patient enough. And for my money, most people just aren't very patient investors. They're just itching to trade. They never feel more comfortable than when they're actually doing something. And the hardest thing in the world is just to sit there and do nothing.
Yeah.
Yeah,
And
I think it's a different skill, by the way. I'm
Mm.
not saying it's invalid to buy something that's a turnaround or something that's deeply out of favor. And it may not be the greatest business, but there may be value in it. But
Yeah.
the thing with that strategy is you've got to then buy it well, and then you've got to sell it well. Because if it's not a very good business or not earning very good returns, you don't want to be in it forever. And then you've got to go and do the same again and again
Yeah.
and again. So I like a more relaxed life.
Yeah, no, and you've got to be able to accept the volatility, because if you go to more risky areas, your hit
Yeah.
rate goes down and your ups and downs get accentuated. So yeah, you've got to be built like a rhino to be able to survive it. Okay,
Yeah.
well, let's move to Auto Trader, which I was looking at the numbers, and it only does 70% EBIT margin, so pretty poor,
Yes.
really. It's not very profitable, this one.
No.
What's your sort of your latest on this one? Because obviously it sells. It's the number one marketplace for used vehicles largely, but it seems to be doing a lot of upselling of products and services into its
Yeah.
dealer, into its base.
Yes. So it's important to say that it's not a dealer in any way, shape, or form. Its customers are the dealers, whether they're physical or online or hybrid. And so what they're doing is basically increasingly getting involved in the technology that's involved in improving dealer efficiency and profitability. So they've moved from being a what to call it, an information website, possibly a price comparison website for, as you say, for used cars, and then they've moved into new cars as well. But to being a company that's also providing other help to the dealers, such as part exchange, making it possible for them to put part exchange into their online offer. They provide information. If you think about, they're the market leader by a long way. They've got all sorts of information on areas on which dealers are doing better and worse. So that, they provide management information to dealers to see how they could improve compared with other people in their area. There are all sorts of things that they're working on just to embed themselves more in the supply chain. But they're not actually physically selling the cars themselves.
Yeah, I'll tell you one bit of information which I could do with is telling me where not to park when the car gets nicked or the parts get taken off, particularly around where I live in Birmingham, because there seems to be really sort of black spots where you've got to be careful. It's quite, and then there's actually quite a bit of consolidation in that area, because it wouldn't be surprised if at some point in time, they ever took a look at Pinewood Technologies, because they've just been recently spun out of Pendragon and specialise in dealer software. Looks like a reasonable sort of, I don't know, anyway.
Yeah, I mean, maybe.
Yeah.
I'm not sure that they have discussed sort of getting into the actual finances of the dealerships.
Yeah, expansion opportunity.
Yeah,
Okay, let's move
maybe.
to another one, which is highly unprofitable. 70% again is Rightmove,
Yes.
which is a property portfolio everybody knows when they come to move to look for their houses and stuff like this. In terms of sort of competition, I did notice there's a US guy who's just coming, CoStar. I think they bought on the market for about 100 million last year. But does that matter? I know the shares dipped on the back of it, but they seem to have sort of come back quite well.
Yeah, so I think initially people were very worried that we got a big US player entering the UK market. Rightmove was toast, but I think it's very hard to unseat the market leader in a network, and that's been proved time and time again across lots of industries. I think Rightmove's interesting because it's following Auto Trader down a certain path. So I would say it's behind Auto Trader on that. But from just being displaying houses for information, to actually getting embedded in the industry itself. And so they're starting to offer mortgages in principle, where they've got they're linked into certain suppliers, and you put in what you can afford, and they'll tell you in principle what you can get. They are also linking in with on the rental market, because sometimes people move from being renters obviously to then being first-time buyers. So providing all sorts of information, and estate agents, obviously most of them have a rental business as well as a house buying business, house selling business. So they're going into the same sort of weeds of the industry, if you like, to sort of monetize that. And it's a very big potential additional market for them, as it is for Auto Trader. Many times just the information market.
Yeah. Would they ever be sort of like disintermediated by sort of like, AI discovery, rather than search, but the next stage? I'm guessing not, but it would just be something, obviously, for most portals. It's sort of a question that you need to ask, I guess.
Yeah. Well, we had, didn't we? We had a company that was, the online only has been quite tricky, because
Purple bricks.
Yeah, because people
That
want
was a nightmare.
People want, I think, to have an agent involved.
Yes.
It's particularly with housing, it's a very big item. It's probably, for most people, the biggest item that they'll ever buy and sell. And so having the agent there with the human touch, and it just doesn't seem as though there's any substitute for that, actually.
Yeah, it's a bit like having your GP, isn't it? Telemedicine's great, but actually you want to go and see a doctor as well.
Yeah.
Okay, well, let's move sectors in media and games. We've got Games Workshop, which again has just been I think it's just been a 10 bagger over years and years and years. What's your latest on this one? Because it seems to have lots of different sort of levers it's pulling for its secular growth, its shops, but more importantly, the films and the digital and the licensing.
Yeah, I think you find it's 100 bagger, actually.
Oh, okay, only 100
bagger. Yeah, the big figure's wrong there.
Okay.
Yeah, so the core business, it's worth saying, is still what they're about, which is getting the hobbyists to actually buy more of the war figurines and to play the fantasy games. And so I think, even though people get very excited about the fact that they've announced that they're in talks with Amazon TV about creating some TV shows with some of the stories, I still think at the back of it all is, fine, we might make a load of money out of that, but what we really want is a very small proportion of Amazon's 250 million global subscribers to actually start taking up the hobby. Because if you got a small fraction of them doing that, it would absolutely massively transform the company, make it much bigger.
Yeah, and I guess they could do that, taking up the hobby online. They wouldn't have to even buy it if they wanted to, but if they want to get the sort of their friends involved, and also, I guess, there'll be masses of opportunity in terms of sort of like, I don't know, even theme parks. I mean, look at Harry Potter, and it's gone bonkers, hasn't it?
But I think it's still always a physical hobby. That they are doing, obviously, computer games as well. Although, interestingly, the last one has been quite slow on the take up. It was developed with Frontier Developments here in Cambridge, and the last we knew, it was quite slow burn. So there's something about the collecting, the physical, playing, a strategy war game with another person on the other side of the table that grips people.
Yeah. Well, maybe you should give, the CEO should give Mark Zuckerberg of Facebook a ring, and they'll do a meta version of it where people could actually be in the game in virtual as one of those figures. That would be frightening. Okay, well, let's move to another one, which has been absolutely fabulous. Seems to be a recurrent theme here. Is For Imprint, which
Yeah.
doesn't do something quite as sexy as Warhammer figurines, but does sort of promotional marketing products, and seems to be on a really strong organic growth
Yeah.
strategy that really is it doesn't seem to be stopping at all.
No, no. So it's an unlikely candidate for being a, a successful area of business, isn't it? You say,
Yeah,
they actually supply products that, promotional products that companies use when they're going to an exhibition, or they're, presenting to clients, and they want to hand out a pen or a T-shirt or a mug, or, a rucksack, whatever it is. That doesn't sound like an area where you could make superior returns and grow and grow and grow, especially, through in the aftermath of COVID, but they've really sort of taken off again. So they don't manufacture much, so it's a procurement business. So it's a kind of a platform, and they're in the States mainly. I mean, over 90% of their business is US, and they don't supply the really big corporates because the margins get squeezed there. So they're supplying sort of medium-sized US businesses, and they have these amazing promises that if it's not right, they'll resupply the rest, and they won't charge you. That if it's not on time, they give you the money back. They lay themselves out to very high standards. And so companies come back again and again to procure from them. And then apart from that, it's sort of a numbers game around their marketing. But they've changed the way they market. It used to be catalogs, and now there's very little of that. So they're doing relatively recently TV advertising, daytime TV. Now streaming TV is fairly new for them.
yeah.
And then they do. They used to sort of be Google search, and now they've got their own sort of brands, and because people know them, they come directly rather than them having to pay Google for a lot of leads. So there's been a big jump in profitability, and they're just gaining share. But I think they have about 5% of the market. It's still
Right.
it's not that high.
Right. So they've got big sort of like an addressable market, that long runway ahead.
Yeah.
Okay, well, let's move to another one. We've got Diploma, which is, again, a best-in-class buy and build sort of distributor, but I think it does specialist niche distribution. And what was really surprising, it bought a US specialty aerospace fasteners business out in the States. And normally when a company spends a bit of money buying a business, its shares goes down and its shares shot up.
Yes, it's got a good record.
Obviously, can you take us through why this
Yeah.
is a perfect fit and why you keep, why you like it? Because it's
Yeah.
done very well again.
Yeah. Well, again, the secret is in returns on capital, and
Mm.
they have very high margins, and that translates into returns on capital, which I think are 20% or something.
Yeah, 20% EBIT margin. So it must be,
Higher, it'd be higher than
must be higher
probably
than that.
higher than that. It's a lot higher than that,
It's a
actually.
distributor, yeah.
Yeah, yeah. So it's quite difficult to encapsulate it. They've got, I think it's 3 divisions, one of which is medical instruments, where you get to they'll go out and find an interesting small producer of a niche instrument, and then they'll do a deal where they distribute for them. And they only distribute in Australia, Canada, Europe, basically the Western countries. They also distribute seals used in earth moving equipment. Right. I say it is quite difficult, this company, to get your head around. But think about if you've got a Caterpillar earth moving truck doing some work, and it's a few years old, it's out of warranty on the seals, and suddenly it breaks down, and you need a new seal very quickly, because every hour that this machine is not working, it's costing you money. You're hiring it, or probably hiring it, and the higher rates are such that you need it back up and running. So that's what they do. They do time critical distribution of small but absolutely mission critical parts in the States, and they've got they'll buy in other interesting niches. So this aerospace one, they do already distribute fasteners for the aerospace industry. I think more in Europe. So this latest deal, people understand, gets them more into the US. They seem to have got it for a fabulous price. They're very disciplined, and this business they're quoting, I think it was 30% margins, and they paid 7 times EBIT for it.
Yeah,
I mean, golly, if I could buy businesses at that price every time, I'd be rich.
Yeah, well, I guess that also the aerospace fasteners, given what's happened at Boeing, and if they've got an exposure out there, then they should be able to pick up some business, because the doors keep falling off some of the Boeing planes because of no fasteners.
Yes. Yes, they're going to need more. And I think they've got it's got a 10-year order book or something.
Yeah.
But it speaks to the discipline and the management at Diploma. They've got some of their incentive is linked to a return on capital underpin, and that's a feature of several of the businesses, the bigger businesses actually. Rotork has something similar.
Yeah. Just on the given it is a distributor, admittedly it makes fantastic margins and stuff, but it's on a sort of 25, just over 25 times PE, etc. When would you get to a stage where you're thinking about top slicing or taking profits? Because I mean, it's obviously done really well over a long period, but it's not cheap at the moment.
No. Well, I would again go back to my DCF value, and I would update it for the latest deal. And I suppose if it was maybe 30 or 40% overvalued to that value, I might think about top slicing a bit if I had a much cheaper idea in the portfolio that hadn't done well and was looking really undervalued. But
How much
yeah,
do you
it's interesting. I can remember Diploma being £2 a share, right, and they're now 36.
Yeah, okay.
So when was the right time to top slice?
Yeah, true.
Yeah.
True. I mean, I'm guessing it's sort of it's picking your spots, and if they are going to be long-term winners, then yeah, you're crazy to sell too early. I mean, for instance, I remember buying Tristel back in 2004 or 5 at about 30p, and I sold at 120, which seemed like a good profit at the time. So I fall right into that bucket of wrongly selling some winners. But just more broadly, in terms of DCF, then yeah, it's obviously a really good way. But how much reliance do you put on it? Because it all depends on what assumptions you put in, and the further you look ahead, the less the accuracy is. And valuation is all about ranges, and it's sort of like what zone it gets to, and just in your view, really.
Yeah. So I think it's worth saying firstly that cash flow is very important, and is a more reliable metric than adjusted earnings per share, because people need to be very careful, don't they? When companies report their earnings per share, there's usually this huge difference between statutory and adjusted, and they adjust out all the negatives.
Really?
And really funny. And they particularly, one thing that annoys me is they adjust out, for example, exceptional costs, restructuring costs, and say they're they're abnormal, but for some companies they're every year. So who are we kidding here? So I think you do need to be careful for that reason and many others about the PE. So with the cash flow, I forecast actuals for about 3 years. So I accept that won't be accurate, but it will be easier than further out. And then I just take the third year, the free cash number, and I just sort of growth rate on it. It fades down to a very sort of 2.5-3% growth rate for perpetuity, taking the view that that's sort of GDP in the world mostly.
And what sort of like discount rate do you use?
I use 10%.
Okay, fine.
Nice,
it's a big
number.
cap. Yeah, okay, gotcha.
It's a nice, easy number.
Yeah.
But
Okay.
I think if you assume these companies are usually very cash generative, so all that the cash builds up.
Mm,
So I don't assume that, for example, Diploma goes and spends that cash on all these acquisitions.
mm,
And so I'm understating their future potential massively.
yeah. Okay, good. Okay, well, let's move on to a bit of a software area. We've got Alpha Financial, which does sort of like software for and services. I think a big part, 50% of the business is in services for sort of asset managers, for well, basically to do car finance and to do plant hire finance and stuff like that. Quite specialised. It came out with a bit of a bid from private equity, which seemed to fall away. What's sort of your
Yeah.
latest on this one? It's sort of it was a darling about 10 years ago or 5 years ago, fell off and then has come back up.
Yeah. So Alpha, I can't actually sit here remember exactly when it came to the market, but it's probably less than 10 years ago. But
Mm,
and it was, as you say, it was hyped up, and they then made the cardinal error of missing numbers
yeah.
after they came to the
Yes.
market. I mean, the market, hates companies like that. It takes a
Yeah.
long while to forgive them. And I think it happened more than once, so it was a bit grim. Um, but they then got down to the point where I think the shares got down to about 60p
That's
about the time
correct.
my fund launched, and I bought them. And we had this enormous amount of cash on the balance sheet, all of which they've pretty well given back now.
Yeah.
So I've had at least half that money back in
Well done.
in dividends. But so what's been happening to the company? So it's quite interesting. So when they were, if you go back only to 2019, they had I think 7 customers who were paying them over 2 million a year, and they've now got 19 paying them over 2 million a year. So you can see that the business is becoming much better spread. They were a bit lumpy with the customers, and we're talking about generally big companies here. So there'll be sort of the Toyota finance arm, or some major finance company in the US, or a big bank.
Mm,
It could be another one. And so they've diversified and won loads of new business. Some of that comes out of the customer's own IT departments. They decide they don't want to do it themselves anymore. And some is winning business from competitors. I think there's one called FIS, the
yeah.
States, which haven't maybe kept investing as much as they should, keeping the software up to date. And I think the top 10 were over 60% of the business, the customers, and now that's 35. So, and they've been putting all their software into the cloud,
Mm,
and so people are now taking out sort of as it were, rental and maintenance contracts. So the business is becoming a lot less perpetual license and increasingly regular, repeatable business. So over time, the business is becoming less volatile and a lot more predictable, and it keeps growing. And they've got some very big addressable markets coming along that haven't been in up to date.
mm,
So one example would be something called US origination. So if you've got car loans in the States, actually originating the loan is a whole business of its own, and it has particular rules in the States. So they've just they've been asked to develop product for that area.
mm. Just, I
Um,
mean, I was looking at the revenue split, and as you say, it's about a third, I think, which is recurring SaaS cloud revenue. You've got about 15% or so, 20% maybe, which is perpetual, but over 50% is implementations and services and stuff. So that's sort of like, putting the system into people, into customers, and then obviously doing upgrades and stuff later on. How come they spend so much time doing that? Because traditionally most software companies would be 15%, 20% max.
yeah, I think it's because this is very complex software. So if you think about a loan from start to finish, you've got the whole business of whether you lend to somebody and all that's involved in that. And then you've got, they are global. So you've got multi-currency, you've got multi-interest rates, you've got multi-jurisdiction regulations. I think it's not a trivial piece of software, actually.
Okay. All right. Well, let's move to another software one. We've got Aptitude Software, which does a sort of like financial automation software for CFOs. So if you're a finance director and you've got a massive team of finance people and you want to improve productivity, you sort of move towards these guys. But mainly, I think, in the finance sector and the telco sector, where there's a lot of complexity. They used to have point solutions, but they seem to be moving now to a more broad suite of sort of finance automation. Can you tell us what sort of attracts you to this? Because they've got a lot of competition in that broad financial platform space.
Yeah, so it's not been one of the most successful investments.
Well, I will let you off on this one, okay. Rosemary, given you've had so many brilliant winners.
Yeah, so I think it's changed its spots a couple of times over the years, but as you say, more recently, it's moved from having software to solve accounting rule changes. So IFRS 16, IFRS 15, 17, these that have come along, and they've gone and designed something for that particular need, and often it's for a particular industry, so insurance being an example. And they're moving from that to offering this sort of automation package for the finance director. I think it's early days. They've invested quite a lot. They are tied in with Microsoft, and that is quite a big tick. So Microsoft have found that their ability to handle huge amounts of data so simultaneously is way superior to other people's. And so along with there was an interesting announcement with the recent results, a separate announcement referring to them being available on Microsoft Copilot for Finance as an add-on. And that is quite a big reference point. And I think the hope is that they will start to see a lot more contracts, and they will announce them if they win them, because it's so early days. So they had a reference customer, which is a long-standing one of theirs called T-Mobile, and they've just won another one in I think the gaming sector. So that's interesting. So it's suggesting that this product is applicable across industries. But I think it is a one for the brave. Wait and see. Hope it works out. It's got cash on the balance sheet.
Yeah, I mean, it's one of those things, I guess, is sort of like it's had a successful strategy in the past, which is now getting a bit of churn in stuff. And so it has to look for newer markets. And you hope it doesn't fall to the sort of like the problems of EKF in terms of adjacent market, but it's actually pretty competitive. Yeah. Okay, well, let's move to Dotdigital, which does all things sort of marketing. Can you just take what exactly does it do? I mean, it seems to do all things in terms of looking after end users across numerous clients, but what does that really mean?
Well, I think if you were to put it into consumer terms, it's a very much more sophisticated version of MailChimp. If you get a survey, I think that's probably a big insult, actually.
Yeah. Okay. Right.
So their history was email marketing. So if you are a retailer and you decide you want to sort of start, doing a lot more marketing online, they will, and you've got GDPR now, got to be compliant with that. So they'll provide all the sort of systems that will help you as a marketeer to set up your campaign and, choose who you're going to sort of mail it to and what the messaging is and the follow-up and everything, and monitoring the responses. I mean, the thing that's interesting is it's not unique to them, but responses on email marketing are really there's very good payback because people can track the response rate, but they have now they've been getting into other media, because it's not just about email, is it? So they're getting onto all the sort of social media, and their products being applied there, and they do an SMS system as well. Dotdigital are not are not unique. I mean, there are quite a lot of companies around that do, in a general way, what they do, but they all have sort of different strengths and weaknesses, and it has been a consolidating industry. So it's not impossible that somebody comes along.
Do they need so much cash? They've got like 37 million quid of cash, which is great. But do they really need all that surplus?
They probably don't. They have made an acquisition in the last year. So sometimes these companies find it cheaper to buy a business than to recruit a whole load of software engineers and develop a new module. So that's what's sort of happening there. So I guess that's probably why they're keeping it.
Yeah, okay, makes sense. All right, let's move to the last one on this sort of tech and IT. We've got Softcat, which does all things sort of like I think sort of IT services in the UK. But surprisingly, I mean, for an IT service, it makes very good margins, sort of 15%. So it must be doing something slightly different.
Well, so I think margins in that industry, so it's a reseller, which sounds terribly boring, and I think maybe people think it is a very boring industry, but if you think about it, they're targeting at the moment mainly UK, again, medium-sized businesses, and if you're using Softcat, they will tell you, when you need to renew your software licenses, if you need some new laptops, if you need new network equipment, how to configure everything. And if you're sort of a medium-sized business, you probably don't have a big internal IT department, so you need help. So the value add is really there. The margin, so they put through the revenue line an awful lot of hardware. So they're shipping in computers or whatever. But it's such a quick turn, it's only with them 2 days or 5 days or something that it's really passed through.
Right.
And so if you strip all that out, they make really very good margins.
Yeah.
Probably more than you're saying. And it's I guess it shows the value add of what they do. It's an interesting. I've been saying to people, I think that this is quite a low risk way to play AI. Because everyone was saying, are we going to buy Nvidia or whatever? But if you've got the resellers, and every company is now wanting to have Microsoft Copilot. I mean, Downing have got it now, and so that's an add-on. It's quite an easy thing. Softcat just says, right, you've got Microsoft Office 365. Here's Copilot, and by the way, instead of paying £30 a month, it's another £30 a month on top, roughly. And then maybe some people will want, more from AI over time. So I just think it's they've sort of said in their recent statement actually that they are seeing incremental growth from that.
Yeah. Okay. I mean, one thing I guess in terms of the sort of value-added resellers, which is a sort of like it's a perennial sort of question that keep people sort of like knocking around, is as things software move to the cloud and then become more out the box, i.e., such that you don't need as much customization and training at the coalface for users and stuff. How does that impact the the value-added resellers? Because it certainly hit the IT outsourcers out in India, for instance.
Yeah. So I don't think their Softcat would be customizing, as far as I know. So they are just, and if you think about, again, back to the user, they just want their hand holding in terms of getting everything in the right configuration, the right brands, the right. I mean, it's like, if I want a new computer at home, I need to go and ask my son-in-law, who's a software engineer, what's the right spec. It's that kind of level, I think. So yeah, I don't think the need for that kind of advice goes away.
Okay, all right, good. Okay, well, let's get to the last one. We've got in the financials and asset manager, we've got AJ Bell, which I use actually as my platform, because it always has. It's been low cost, very easy,
Good.
dependable, and to be very honest, and this is not an advert for AJ Bell, but it's the best one I've come across, and so I'm sticking with it, and I
Yeah,
refer customers to it, which is probably of the best promotion that
it
you could
is.
do for telling me
I'm
why you bought it. But
I'm very pleased to hear it.
nonetheless, it does facing headwinds in terms of fund managers and asset managers and the consumer duty which has come in.
Yeah. So I think the risk that the market's worrying about at the moment is there's a regulatory investigation into all these platforms in terms of what interest they're paying on client cash balances and whether that's justified. And so that's unnerved, the market, and we don't know how it's going to fall out. All I'd say on AJ Bell is that they're quite clear that while they do not pass on all the benefit of the bulking up of everybody's cash and putting that on deposit, they do, however, as a quid pro quo, have lower fees than many of the competitors, and so they suggest that one should look at this in the round. I think that's their basic position, and we, seems a reasonable argument overall. Although for individuals, maybe if you've got loads of cash, you might lose out compared with someone who didn't have any cash. I guess so. I don't know how that will work. So yeah, I think the jury's out on that one. But I mean, if they have to move and amend, obviously they will, won't they? But they do earn a lot of profit on client cash. It has to be admitted. It's not easy to. They don't exactly disclose it. You have to kind of ferret around to try and estimate it.
Yeah. I think you've actually chosen, though, the best one in the industry. I'm a practitioner or, a user of it for 30 odd years. And then really I'm on Hargreaves Lansdown and AJ Bell, and AJ Bell for me is the best, easiest. So if I was going to buy one, I would buy that one as well. Okay, good. That's a brilliant run through of a lot of really good stocks there, Rosemary. Now, just finally, in terms of when do you sell stocks? I mean, what sort of triggers the Rosemary Banyard sort of like, actually, I want to get out of this?
So one answer is, though, if you take last year, I had 3 sales, complete sales we're talking about here, and 2 of them were bids.
Okay,
which goes back to what we said at the very beginning about this. But in terms of sales, it's usually because I feel I've got it wrong, and what I thought was a business with clear barriers to entry has proved to be not so resilient. In the life of this fund, the last 4 years, I would say that the big pattern of disappointments has been companies which have ended up with too much debt, and with interest rates now normalizing, that's been really quite painful. So I prefer. I mean, I don't know. 2/3 of my investments don't have any debt. So it's quite conservative. But there are other reasons. So I did quite successfully sell out of Avon Protection a while back, because it's like if the story changes, and often that is associated with acquisitions, which might sound good, but they're actually a real a risk. So they made a couple. One was helmets, because they do the gas masks. And I thought, well, it was a family business, and I thought, retiring family and helmets make sense with gas masks. Can see that. The other one was body armor, and I started to think, I think Morgan Advanced had body armor business, and they got out of it because it was just very unpredictable and lumpy. And then I got to thinking about what is body armor, and it's like Kevlar with sort of plastic sort of shape to the body. It's not, where's the value add in that? It's probably in the Kevlar.
Mm.
And I just thought, I just didn't get. I wasn't very comfortable, so I sold, and shares went down a long way actually. So yeah, it can be something very specific, like an acquisition that doesn't look right, or it's just a company where it's been a very testing time, hasn't it, for companies the last few years, but it's rather showed up if you've got sort of not perhaps got the sort of strength in the business model that we thought you had. There was one company I got horribly wrong called XP Power.
Yes.
And I felt that they'd got these contracts. They weren't able to pass on price inflation for months and months and months because they've got fixed price contracts. It seemed to me that they'd got supply chain challenges and maybe not the pricing power that I had hoped they had.
Yeah, and you don't sell on valuation then, because I mean you take that longer term view with the DCF.
Yeah, I sometimes will, as I say, just finesse so if something's done really well and it's going to be a big weighting in the fund, and it's trading at a big premium to what I think the value is, and there's something else that's not done well and it's at a big discount, I might just trim the one and add to the other, sort of even, and it even has the merit of evening up the weighting so they don't get too out of kilter. So I would do that. It's very hard, isn't it, psychologically, if you sell out of something completely to buy back.
Yeah.
You found that? I find
that.
Yeah,
I have. Yeah. No, I mean, it is. I mean, perfectly honest, a lot of the time, if you start selling, I end up selling the whole lot, actually, which is perhaps definitely not the right thing to do. It wasn't on Tristel, that's for sure. Okay, brilliant. Well, thanks very much, Rosemary. If anybody wants to invest in Downing or in your funds in Downing, how best to do that?
You can go and find information on the Downing website, Downing Unique Opportunities Fund, and there are other funds in the stable as well.
Brilliant. Okay, well, thanks again for your time, and look forward in touching base in 6 months' time. Best of luck.
Thanks, Paul. Bye now.
Bye.